Good afternoon and welcome to HYCM's trading workshop with myself, Giles Coughlin, Chief Currency Analyst here at HYCM. It's great to have you on board. Just if you could let me know if you can hear me okay on the question panel, that would be helpful. Hi, Aaron. Good to have you back. Danish, Sammy, Van, Toby, and Mr. Nguyen. Lovely. Okay, Sammy, that's great coming through. Okay, that's super duper. Well, just as other folks are coming into the webinar, I will just go through this disclaimer as I do each time, just to remind that as we're looking at different, currency pairs and setups and sometimes entries and exits, this is not a signal service. So the idea is not that I'm showing you which signals to enter and where to trade. Instead, the whole idea of this is about education. So you don't need someone like me, that you can eventually make good, sensible trading decisions for yourself. So that's the whole ethos behind the workshop. It's to show you guys how to yourselves through education, so you can more understand the market moves, why currency pairs are moving in which direction, and then from there you can start to make your own trading decisions. So that's just to make it clear that it's not a signal service. So we'll just go through the session ahead that we have, the special topic which we're doing. And this is an important topic this week. Now, this is the importance of trading fresh and changing sentiment. It's been occurring to me recently, obviously, running these webinars and workshops, each week. I think to myself, what is a really helpful topic for either a new trader, a struggling trader, or a trader just trying to take their trading to the next level? And I think this is probably one of the most important aspects after you've grasped the other basics. I think this topic that we're going to look at today of trading fresh and changing sentiment is arguably one of the most important ones. So I'm excited about that because I think you're going to find a lot of value in it, and I really do hope it's helpful for you. So pay special attention to the special topic, and it's slightly longer than usual. So I'm going to try to make sure that I leave enough time for us to cover this important topic. So I'm excited about that today, so I hope that's going to help us. And don't forget the handout for the session. As always, it is under the handouts tab, which is on the GoToWebinar control panel, just under workshop guide September the 10th. If you just click on that, then you should see a handout appear like this. And for those of you who just joined the webinar for the first time or recently, the whole idea of this handout is that you can print it out, put it on the side of your desk, and then you can refer to it during the market sessions as you come to trade yourself. The whole idea, these 5 topics, looking back, forward, looking at charts, looking at risk, looking at the outcome of your trade, is to give you a rough outline on which to make your own trading decisions. What sort of things should you be looking at? What do I want to miss? How do I choose currency pairs? Those kinds of aspects. And those of you who've been following me for a while, you understand all that now. And the Telegram channel that I provide content for HYCM, it follows exactly the same kind of outlook. So it keeps everything the same from the similar perspective. Any topics you would like covered, just email me here, giles.coughlin@hycm.com. And the big issue, again, that we're looking for is as we come to the start of the European session, the American session, we're always looking to find which is the strong currency, which is the weak currency. We're always trying to pair currencies with opposing outlooks together. That's kind of the heart of what I'm trying to do every day in the market. I'm always trying to look at different currency pairs that have different reasons to go in the opposite direction, because then you know that you're likely to find sellers on retracements or buyers on pullbacks. So that's really the heart of what I'm looking at here, finding that that straightforward trade where both currency pairs are going in different directions. And those of you who've been following this for a while, you see that these kinds of trading opportunities occur time and time again. So it's just a question of practicing, repeating until it becomes a second nature. So as we get going, Turn to your handout. I'm going to be basing it rather loosely on that handout this week because I want to spend plenty of time looking at that special topic of trading fresh and new sentiment. I don't want us to miss that today, given how important it is. So the first thing that we want to do when we start looking to trade is to look back, okay? The reason we look back is because we want to see what sentiment, what mood is influencing the market and which currency pairs does that impact, okay? So that's what we're looking back. So, you know, a very obvious case would be, say, for example, you came to your desk and overnight a central bank unexpectedly cut interest rates. Then you would know that that currency would have a weak bias. And you just know that that weak bias is in the market, and that weak bias can provide an opportunity for selling that currency. That's the kind of thing, that's an obvious example. That's the kind of thing we're looking. And we saw an example of that this last coming month when the Reserve Bank of New Zealand unexpectedly cut interest rates by 50 basis points. We saw the New Zealand dollar sell off immediately, and then we saw the New Zealand dollar retrace and then sell off again. And I took both of those moves. I took the initial announcement and then I traded a retrace. So there were two opportunities to get into that trade, and that's the kind of sentiment shift we're looking at. We'll cover it in more detail. Looking back, let's start. Okay, so first of all, we're looking back, and the first thing I want to look at is I want to look at the Asian equity markets. The Asian equity markets were mixed overnight, okay? So we're in a scenario where risk sentiment is still kind of, this morning it was kind of just mildly positive. We've still got a slightly mildly positive this morning, risk sentiment on the US-China trade optimism. There's no deal Brexit. That's been sort of less chance of that happening. There's just been generally some, you know, good chat between the US and China. So that's from a previous week. And all of that has led to the Nikkei was up marginally, the Hang Seng flat, the Shanghai down marginally. So it wasn't a strong risk on market by any means. However, given the fact that we've been in the context of a risk on sentiment for the last sort of 3, 4, 5 days, you know, it's still there. So coming to the market still saw that risk on sentiment. Remember the US-China trade war, just to remember again, with China and the US making up 40% of the world's GDP, what happens to them affects the entire globe. That is why we are constantly seeing a focus of the market on the US-China trade, you know, disputes. It's very, very important. What's good for the US and China is good for the entire globe. So that just gives us some kind of indication of, you know, how strong an influence those two countries have on the globe. So looking at it, there's a couple of things that I want to draw your attention to, just slightly more insight that will be helpful. And this is the key thing to realize, is that risk off sentiment can enter the market at any time, okay? Recently, we've been seeing the safe haven currencies, the yen and the Swiss franc, selling off. For those of you who've been following me for a few weeks, I hope that was obvious to you. I hope that was standing out to you. I hope you could see, aha, okay, the US-China trade war talks are going relatively well. So I know that I'm seeing the yen and the Swiss franc selling off. So over the last few days, that could have provided you with a very, you know, easy pair currency rather, because you think, okay, well the yen and the Swiss franc are being sold off, so they're my weak currencies. Okay. So, however, having said all that, the risk-off sentiment is risk-on sentiment is very fragile. It's only got to take one tweet from Donald Trump, and just to let you know, there's billions of leverage funds that are linked to the S&P 500, and a number of those are passive tracker funds. In other words, there's a lot of people who have a lot of money linked up with the S&P 500, and those funds are leveraged. So in other words, if the S&P 500 starts falling, a lot of those leveraged funds are going to find themselves underwater much quicker than they potentially realized. So when a fund's leveraged, you know, a 1% drop in the S&P 500 for a leveraged trader would be at least a 2% drop for them. And in fact, because of the way that many ETFs work, it would equate, after the fees, the administration, and the way that the leverage funds linked to the S&P 500 on a tracker, often you would find that those losses would be 3 or 4 times the amount of the S&P 500. So what that means is that the S&P 500 is very, very vulnerable to a correction. So you know, a lot of those leverage funds would pull out quickly when they start seeing their equity really falling fast. Okay, so just to be aware of that the construction of the S&P 500 with all the leverage funds linked to it are makes it very vulnerable. There's also a lack of liquidity in the secondary credit markets due to the increase in banking regulation. So in other words, risk-off sentiment could come very quickly. So don't be married to this risk-on sentiment that we're seeing in the market at the moment. The perspective that I'm having, and I think it's a helpful perspective, is okay, as long as the risk-on sentiment is around, that's fine. We can accept that the yen and the Swiss franc are going to be weaker. That's fine. We're not going to go against the market, but we want to have an awareness that that could change very quickly. So have that in your head. I would say look at a pair like the New Zealand dollar Japanese yen pair, the Australian dollar Japanese yen pair. They'll be very vulnerable to a sudden switch in risk sentiment. So if all of a sudden Donald Trump starts tweeting about how, you know, I'm going back to war with China, they're going to be sorry that, you know, they have a mess with the US, we're putting on more tariffs, you know, that kind of language, we know, we've seen it before. If that happens again, you can expect like a pair like the Australian dollar Japanese yen to fall very hard. Okay, that's the kind of situation we'll be aware of, and be aware of it in advance. Okay, so think in advance, and if the risk of sentiment turns, which currency pair would I look to trade and why? Have that in your head. A go-to currency pair for me when risk-off sentiment comes into the market would be something like Australian dollar Japanese yen, New Zealand dollar Japanese yen. Both of those are helpful for me at the moment. I hope that helps you guys. Now, so going into the Asian session, quick recap for you, particularly if you're new. Why do FX traders care about the equity markets? I bang this drum because it's important, especially if you're a retail trader and you don't have the access to a Squawk service telling you when the market's risk on, risk off. Then you need to do this analysis yourself. So why do FX traders care about the equity markets? It's a question. You answer it in the question panel. Please let me know. Don't be afraid to speak to me. Don't be afraid to get the question wrong. There's no stupid question, and there's no harm in getting questions wrong. It's how everyone learns. It's how I learn. It's how you'll learn. And say, you know, speak now or forever hold your peace. And give you a minute or so. Why do FX traders care about the equity markets? Type it in the question panel now for those who are listening. It's important to be able to recognize when we're in a risk on, risk off sentiment, and equity markets are very, very sensitive to risk. So, okay, Sammy, Starman, well done. Yes, Toby, Sammy, you've got it. That is why FX traders care about the equity markets. Okay, so thank you, Toby. Thank you, Sammy, and well done. This is the way it works, okay? Is the equity market shows the risk appetite. When an equity trader, they're very, very sensitive to market risk, equity traders. So as soon as there's a perceived risk, money starts rotating out of equities and into bonds, okay? There's a school of thought that says you should either hold equities or bonds. So that's why you see this kind of, I'm just having a look at your answer. Yeah, Saeed, I think you're on the right lines there. what you see is when the equity markets are falling, it's in a risk-off sentiment, okay? And when the equity markets are rising, it's a risk-on sentiment. So that's why currency traders are looking at risk sentiment very carefully. I was trading the US dollar, Canadian dollar, and the Canadian dollar Japanese yen pair last Friday. And I was just glued to the equity markets because I knew that with the CAD yen pair, I knew that CAD was impacted by oil prices, and I knew the yen pair was going to be impacted by equity prices. So as I was monitoring my Canadian dollar Japanese yen long pair, I was looking at oil and S&P 500, S&P 500 futures, the Dow Jones, the Nasdaq, and I was using that as my barometer for how the trade was going, and it's very helpful. So sorry folks, just turn my phone off. So that's what we're doing, okay? That's what we're looking at, the equity markets. Here is a quick cheat sheet for you. If you are struggling with this correlation, take some time to understand it. Just screenshot this. If you screenshot that trade, that screen rather, that screenshot will help you, okay? It will give you a cheat sheet, as it were. So do that until it becomes second nature. And if at first this is struggling for you, just keep looking at it. Just look at it every day. Okay, question from Danish, what is risk off? Right, Danish, good question. And what's risk on? Yeah, how to catch a switch of sentiment quickly, Sammy, that's what we're covering later. So we're going to cover you all. Let's do Danish first. Right, Danish, when we're on a risk is to do with how risky is the market feeling. Is the market wanting to take risk? Risk on. Is the market not wanting to take risk? Risk off. When the market wants to take risk, we see stocks rally. We see shares increase, okay? And you just look at like the FTSE 100, the S&P 500, the DAX, the Nikkei, look at the major indices, okay? And that tells you what's happening. When the market is worried, we have a risk-off environment. That's when we get stocks falling, okay? So this is why it's important. When you've got a risk-on market, this is what happens to these currencies. When it's risk-on, the higher yielding currencies, like the Australian dollar, the New Zealand dollar, and the Canadian dollar, they appreciate. These currencies are bought on risk-on markets, okay? Conversely, the yen and the Swiss franc are sold off. That's why, look at your charts, you'll see over the last few days, when the market's been risk on, we've seen the yen and the Swiss franc have been weak. And we've seen the Australian dollar, the New Zealand dollar, and the Canadian dollar have been strong. So here's a quick look. Here's a quick look at, like, let's just look at the Australian dollar, Japanese yen pair. Right. Let's get daily chart. Right. You see here, okay? 1, 2, 3, risk on market, okay? Risk on market. Now, as I told you, risk on market is sensitive. So we're now reaching, look on the Australian dollar Japanese pair, a very key moment. So you've got descending trend lines, daily chart, bing, bing, bing. We've got a horizontal support and resistance. And I marked this in a couple of days ago, this level. It's a level I'm just watching. Very key level, just 7,400. So you can see, look, getting above here is hard, okay? And you can see there's profit taking some obvious place to take profit, descending daily trend line, overhead support and resistance. And the point is, you can see here, and look, I just drew a trend line, very simple trend line here. And you can just see that trend line. See that trend line's just being broke. It's a bit rough and ready, so I'm not going to pay much credence to that at the moment. But what I am paying credence to is that this big descending trend line on the daily chart. Okay, so you get the point. Okay, so Danish, when you see a risk-on market, you'll see the Australian dollar appreciate and the Japanese yen you are seeing fall. Okay, so let's just get rid of that, put that back on my other screen. Here we go. So that's a risk on market. Danish, take a screenshot of this, it'll help you afterwards. Now, risk off market is the opposite, Danish, okay? So when it's risk off, you see the yen and the Swiss franc appreciate, and you see the Australian dollar, New Zealand dollar, and the Canadian dollar depreciate, okay? I look at the Nikkei as a good, first thing in the European session, I look at the Nikkei to see what happened overnight. So the risk off market, you'll see the Japanese yen appreciate. Now, if we go back to that chart, the Australian dollar Japanese yen chart, we'll see that the market has been in weeks and weeks of risk off, right? And the reason it's been weeks and weeks of risk off, it's been all this kind of, Donald Trump difficulty. Remember from Donald Trump about December 2018, we saw those huge kind of sell-off on equities, big risk-off market entered. And so look, we've seen that the Australian dollar Japanese yen pairs fall from 83 down to about 70. Okay, so that's thousands of points. Okay, so that is why traders focus on these, and you've got to understand this. You've got to have this down. So this isn't an area of trading to ignore or think I don't understand it. Just work on it, because it does get easier. Just screenshot that, screenshot that, screenshot that. If you haven't done it now, go back into the explanation of the playback of the video and look at it there. Okay. So quick test for you. This was a snapshot. In fact, let's do it right now. Let's do it right now. I'm just going to pull this up on my other screen. And I'm just going to take a snapshot of the market as it currently appears. And then I'm going to ask you to tell me some of the things you can see about this market. Okay. That was a snapshot I took earlier. So here is the market. Okay, so looking at this, what can you tell me about risk? Sorry, I just plugged my charger in. I hope you're still there with me. Okay. What can you tell me now about risk? Have a look at the equity market. So the equity markets here, S&P 500, they haven't opened. This is still from yesterday. They're due to open in about 7 minutes. So what you have got is the S&P. You got the European indices. That's the UK FTSE, Euro, French, German, Spanish, Portuguese, Italian FTSE. Then you got the Japanese Nikkei, Chinese Hang Seng, Shanghai. So you've got they're the indices there. This is bond yields here. Okay, so we've got bond yields, the 10-year just marginally up. Tell me, what would you say about this? What are we at? Danish, no, you can't get this workshop PDF, but if you do a screenshot, it will help you. And go back to some of the recordings, Danish, on the HYCM website. You'll see the Danish. You'll see the recordings that you can screenshot. Okay. Yeah, Sammy. Toby. Yeah. Yeah, thank you very much. Ifam, Syed. Yeah. Well done, guys. You've got exactly the idea. Okay. So everyone here who's replied, yeah, that's it, Sammy. Bonds are up. That's bond yields are up, which is it's slightly complicated because of the different relationship between bond yields and equities. Just focus on equities for risk at the moment. It's going to be the most helpful. And everyone here has said that we're in a risk-off mode, and I would agree. I think we're in a marginal risk-off environment. We're seeing the European equities, they're a mixed bag. We saw that the Hang Seng Shanghai Nikkei was a mixed bag. Be interesting to see what happens with the S&P 500 opening in the next 5 minutes. But I would say we are in a mild risk-off tone, vulnerable to more downside. So this is one of those situations. It's not obviously risk-off massively. It's not massively risk-on by any means. It is tending more towards risk-off. And what we're looking for is looking for a lead from the S&P 500. So once it opens, next 5 minutes, if you've got time, we'll have a quick snapshot and look. But the thing to look for is a sudden deterioration in risk-off tone. As I've said before, when we get the moves of like 1% or plus 1% in the equity markets, that's when you pay attention. So this VIX is the volatility index. So look, yesterday was kind of indifferent, flat, futures flattish. This morning we've got the UK 100 flattish, really, Euro flattish, French flattish, DAX just marginally up. Do you see? So when it's 1% or more, that's when you want to pay attention. So the Nikkei 0.35. So not massive moves either way. The market is in a kind of like wait and see mode, and the market's waiting for the ECB rate meeting on Thursday. So we're in a mild risk off and not much going on kind of mood. So that kind of tells you a lot. Well done, everyone, for recognizing that. Is excellent. Okay, so now we're looking back. Asian session. The key news was Donald Trump reiterated that China wants to talk and that hopeful the US can create conditions for trade talks. So mildly positive. China's inflation data came in very strong, but this was largely influenced by pork prices, which were hit by the swine fever outbreak. I don't know if you remember that swine fever outbreak in China. It meant pork prices really rocketed up. So although the inflation data would normally be supportive for the economy and show that interest rate increases are coming and it's generally upbeat, this was upbeat, but it was for the wrong reasons. So again, context is everything. Okay, so that was in the China data overnight. UK PM Johnson was defeated last night on a UK. He wanted to try to get a vote in the UK Parliament to have an early UK election. He was defeated on that vote, and so UK Parliament begins its 5-week suspension. This is what's going on with Brexit now. This is called the prorogation of Parliament. So this suspended comments yellow box means that from now, the 10th, we're Tuesday, so 11th, 12th, all the way through to the 14th of October, we have prorogation of Parliament. So there's nothing much happening now in the UK. Okay, Parliament can't meet. Some of the crazy kind of constant Brexit headlines are going to die down with Parliament not meeting. So there's potentially a quieter patch. I don't want to say anything too definitive on Brexit because you just can't. It's so unpredictable. But I would anticipate a quieter time for the pound, subject to really big headlines. So this should calm down a bit for the pound, and the pound is generally being supported on a optimism that a no-deal Brexit will be avoided. That's kind of the mood that's currently in the market, but you might expect some of those longs to start covering their longs shortly. So watch this space. That's just the rough calendar of what's happening. Just looking quickly back, this is a simplified version of the possible events. So the legislation was put forward to delay Brexit. Let's follow it through. That passed. Now, PM has tried to call an election, but he hasn't been able to. Eventually, we're heading to an election in the UK. But the battle that's on now is we're due to leave European Union on the 31st of October. So what Boris Johnson is trying to do is delay it as much as he can. Okay, so can he delay the new law? He hasn't been able to delay the new law. The new law that delays Brexit has passed, and that has meant that Parliament's prorogued and MPs can try again after the 14th of October to try and get some kind of new arrangement or new deal. So that's currently where we're at. The chances of no deal are going up all the time, although this delay to the Brexit no deal exit has meant that the chances of some kind of deal have just gone up recently. So it's basically the stakes are getting higher, and the outcomes are becoming more stark. So, you know, a deal could be done and the pound will rally strongly, or a deal won't be done and the pound will fall strongly. That's kind of where we're at. So this is just one to wait and watch. And only, you know, I'm only trying to trade the obvious sentiment shifts. When there's an obvious shift and it's predictable what's happening, then I want to join that kind of trade. Otherwise, I'm just staying out of it. So that is from a previous week. Now, the sentiment that I got for the coming session, I got a weak Swiss franc and a strong Australian dollar. Now, that was this morning when I came to my desk this morning, and I was seeing this morning some mild risk on tone. Okay, so I was looking for any buyers on pullbacks. Okay, so here was a 15-minute chart. So I was looking for expecting buyers from this region, the 50% region, and the 61% Fibonacci retracement, which is also, you know, with these recent highs here, and the 200 exponential moving average. So this kind of area, the 0.6785 and the 0.6790 were two areas potentially to look for long. And I haven't entered the trade. I was looking for a, you know, potentially a deeper pullback on that. And I'll be monitoring equity markets going forward for this afternoon. So that's a currency pair that I was looking at. Again, that's not like a, you know, wasn't like a really, really high conviction, strong trade. But if you had to trade, you know, that was the currency pair that I would have chosen this morning. European session, just approaching, we're midway through the European session, heading into the US Open now, and just looking at the charts, the US has just opened a couple of minutes ago, and we're 0.36% down on the S&P 500, Dow's down 0.11%, and Nasdaq's down a full 0.5%. So, you know, that risk-off bias is translated straight into the US equities. So that's one thing to watch and keep our eye on. So for the sentiment for the US session, one potential that I saw was potential for a stronger pound and a weaker yen. Now, I was potentially expecting buyers on the pound-yen pair, expecting the pound to be stronger, the fact that the chance of a no-deal Brexit has been delayed, Parliament's prorogued, so things should be quiet on the pound front, and then expecting a weaker yen as long as the risk tone remains okay. So let's have a look, looking at the, just going to call up the TradingView chart as well. I like these charts there. They look quite attractive, and they're easier to use, I think, than the MT4. Well, certainly for doing analysis, I prefer them. So looking at the pound-yen pair, you see we can see the yen's been weak, so that's what we've been seeing, this buying pressure. Now, as long as the equity markets remain supported, then I would expect the pound-yen to keep rallying. So maybe I would look potentially to buy on a pullback. So the pullback that I would be interested in would be a pullback like to this 132 level, would be probably the level that I would look at for today. So if where I'd expect buyers, I'd expect buyers around here, around the 132 level, which you can see coincides resistance, broken resistance becomes support. So you've got a pivot point here. You've got the 132 level, 200 exponential moving average. You've got a pivot point just underneath. So, you know, potentially longs from 132, stops below 131, and looking to take profit here, 132.60.70. So that's potentially what I would be looking at today. That's what I expect buyers to be looking for on an intraday trade. But the key thing is obviously risk sentiment. So that's what, that's how I go about looking at that. Let's move this away without closing it this time. Right. Now I want to make sure we have time for the fresh sentiment. So I want to get stuck straight in for this. Right. Okay. So fresh and changing sentiment. I want to do this. I want to make sure we've got time to do this. It's very important. Now, when the market is quite quiet, as it has been recently, there's a temptation to just jump into trades. Okay. Actually, in these quiet markets, as we're waiting for the ECB, it's quite important to try to stay out of unnecessary trades. It's easy to lose profit that you made on volatile times in these quiet times. So one of the ways to help you do that is to focus on fresh and changing sentiment. When you think about trading, if you had to pick an ideal trade, it would be a trade that you enter that goes into very little drawdown and hits profit relatively quickly. Okay, we want trades that go one way. So one of the kind of scenarios where we get those sudden and fast movements are when there's been some fresh changing sentiment. Okay, now food is best enjoyed fresh, right? We all know that. Fresh food is the best food as a general rule. Okay, now fresh and changing sentiment is similar. We want news that is fresh and new and significant. So the key principles for trading fresh sentiment are you need to pick which sentiment change to focus on and then trade that sentiment while it's still fresh. So you need to get into the habit of finding what is the sentiment that really upsets the status quo. What is the sentiment that really, is significant? Because that's the sentiment that we want to be focusing on. So let me give you an example, okay? So the very best time to trade sentiment is when we notice the sentiment change. Here's an obvious example. If the market is in a risk-on mood and has been for 3 days, is it a change of sentiment if it carries on in risk-on mood? No, it isn't a change of sentiment. It's not really a surprise. If we have a data point that's released on Monday, is it a surprise to hear the news about the same data point on the Thursday? No, it isn't. So with the best opportunities, or the most straightforward opportunities, are when we notice the sentiment change. So it could be a surprise data point, it could be a political development, or some other unexpected event that causes the currency to move. Okay. Now, just so happens there was a good one today. It's a good one to make the example, but it's not a very good one for trading because of the large spread that's involved in the currency pair for most retail traders. And it was the Norwegian krone. Okay. So the outlook by the Norges Bank was being pretty optimistic for the Norwegian economy. Okay, they had an upbeat assessment of their economy. They were pretty strongly hawkish in a fairly negative central bank world. Okay, now the inflation data came out today, and it was a miss. The headline for August was down 0.2%. The core inflation was down 0.1%. The year-on-year was down 0.1%. And the CPI index year-on-year was down 1.6%, was 1.6% versus 1.8% expected. So 1, 2, 3, 4, 4 misses on the Norwegian krone. Now we know inflation. When inflation rises, that will mean interest rates will increase. But when inflation is falling, that means interest rates are less likely to increase. So in other words, we had some significant news because the Norwegian bank has been upbeat on the economy, but the inflation data suggests otherwise. So we would expect immediate Norwegian krone weakness on this data point. And that is exactly what we saw, okay? So this is a key sentiment shift. So let's have a look at the chart. So here is the Norwegian krone pair. So we saw the data came in this morning, 7 a.m. British summertime. We saw the market rise up quickly. So 15:30 for the next hour, the market was being bought. We'll get rid of the pivot point. We'll pop in a Fibonacci retracement from here to here. So in this kind of situation, okay, there's kind of two potential opportunities to make the trade. Now, there's on the announcement. So if you got on the announcement here at 7 o'clock, say you got in, within 15 minutes, usually you want to get in within 5 minutes or so, but say you got in about 15 minutes, you can see that there was quite a lot of upside. Now, the problem in this pair is the spread's large. So this is not really practical for trading. This isn't something you should trade now. So you could have ridden it up for those pips, okay? Could have gone up towards, one of the big round numbers, 8.9, 800, something like that, 8.9850, okay? 1.8700. Could have ridden it up to one of those big round numbers. Now, say you've missed that move. Is that news fresh? Yes. Is it significant? Yes. In which case, there's a second opportunity that's valid for about 24 hours to 48 hours. And the way to trade that second opportunity that's quite helpful is just to trade the 50% retrace. So it would be to expect buyers here at the 50% Fibonacci retracement level, pop stops below, and trade up to the shoulder of those highs. That's a little head, two shoulders. So just trade up here, 8.9800. Okay, that would be an obvious target. Okay, so you're looking from here to here. That would be your second chance entry on a fresh changing sentiment. So when sentiment is fresh and changing, two opportunities. One, the initial announcement. Two, the retrace, valid for about 24, 48 hours, okay? That's an example today. As I said, not tradable because of the spread on the Norwegian krone. If you looked on your charts, you'd see a massive spread for that pair, and it's not worth it. It's not worth taking that risk for such a small gain, okay? So it's not practical. But the principle is exactly the same. So the challenge that you'll have in trading sentiment is that there's lots of different data points and comments that flow across feeds, but not all of them move the market. So the first thing to realize is that sentiment varies in importance, but I'll give you a clue. The market will often tell you what it's focused on. So if you don't understand, say all of a sudden there's a massive spike in, in a currency pair on a data release, then that gives you a clue. The market was focused on that data release. Then look into the details. What was the market expecting? Why did it move that far? What are the, is this move likely to last? Start asking yourself these questions. Over time, it becomes easier. But the key thing to realize is that not all sentiment is equal. Just because something's good news or something's bad news doesn't mean that's tradable, doesn't mean it's significant. So not all sentiment is equal. So it's important to recognize which sentiment is going to be important ahead of the event. All right? Learn to get into the habit of recognizing what sentiment is going to be important ahead of the event. So say, for example, if imagine a central bank had said, as soon as we get inflation figures above 2%, we are definitely going to be raising interest rates. Okay. When that inflation figure is released, how important do you think that would be? It would be very important because the central bank are focusing on it. The market's been focusing on it. So then if that data point comes in, that inflation data comes in at 2.4%, you're expecting a quick and an obvious reaction in the currency. You'd expect the currency to be bought instantly because it would be. And in that scenario, you'd have two opportunities. You'd have the opportunity to trade the initial spike, and then you have the opportunity to trade the 50% retracement up to the recent highs. Okay. Focus on the changing significant sentiment, particularly when you're beginning to trade. It's going to be helpful for you. Okay. So you need the following elements for a decent sentiment trade. You need a clear bias going into the event. You need to know what's significant, what isn't significant. You know, often you get these analysis reports. Yeah, Danish, if inflation is going up, the general rule is the only way a central bank can control inflation is by raising interest rates. Central banks around the world have a target for their inflation between around 2 to 3%. If inflation gets too high, a central bank's reaction to that will be to raise interest rates. If inflation levels become low, the central bank's reaction would be to cut interest rates, okay? Or stay on hold. That's the basic element. So following elements for a decent sentiment trade, you need the clear bias, you need a data release or event that clearly confirms or contradicts that bias. In other words, it needs to be clear that market will respond in a certain way. You know, often you see analysts, and you can see analysts will say, okay, this event is coming up. If the central bank do this, we're expecting that. If it's that, we're expecting that. This is what they're trying to do. They're looking into the event. What are we expecting to happen? Okay. So here's an example of a trade that I took in August, just a few days ago now. The Reserve Bank of Australia minutes, they came out on Tuesday, August the 20th, and I was asleep. So when I woke up, I read the analysis on the minutes, and basically the minutes were seen to be quite positive for the Reserve Bank of Australia. The chances of a rate cut from the RBA went down to around 12% from around 50% the previous week. So in other words, it was very positive for the Australian dollar. I knew that the outlook for the Reserve Bank of New Zealand for the New Zealand dollar was quite bearish. Okay, they cut rates. They're in a quite a down mood about the currency. So I realized, okay, well, there's a difference. The Australian Bank, RBA, New Zealand Bank, RBNZ are doing different things. The RBA minutes confirm that difference. Yes, that difference is valid. So this is what I did. Having missed the release of the minutes, I set orders to buy not on stop, to buy at limit, apologies, around the 50% fib level and took profits at the price high. My order was filled about 12 hours after the minutes, but I got it while it was still fresh. Okay, so here we go. This is an example I took. Right. Here, the minutes were released. This is 15 minutes chart. Minutes were released. That was the initial spike up from 1.0546 to about 1.0575. So a good 30 points, right? Straight off the bat, roughly. You know, if you got in 5-10 minutes of the event, say you got in at the very top, you could have been, phase one would have been here to here, okay? Now I came to my desk. I get to my desk at 6:30. So this is where I got to my desk here, saw the large move, but well, you know, where do I want to? Yeah, I thought, oh yeah, I like that. That's a divergence that I'm agreeing with. I'm expecting a strong Australian dollar. I'm expecting a weak New Zealand dollar. Now, where do I want to enter? Well, I want to enter at a 50% retrace And where am I trading? I'm trading up to the recent highs. So you can see my entry is here. So I entered here, just above the 50% level. And then you can see I went into a little bit of drawdown. My stop was here. You see, it was below 1.0531. So I gave myself plenty of space, right? Because look, there's a descending trend line here I've got. So I'm thinking to myself, if this goes, then I'm likely to find buyers here. If that goes, I'm likely to find buyers there. And if that goes, then I've got something wrong, okay? So that's my logic. Just put your stop right out the way. You see, you might think, well, I'll put my stop here. The problem if you put your stop there, you might have got a little quick stop hunt. You might have had a quick rundown. The market does hunt stops, so try to find orders, and then it might just pop back up. So just below this trend line, this second swing point here, nice and out the way, okay? Then price moves down and just take profit up here. So you can see that the minutes on the 20th of August, I entered the 20th of August and I'd taken profit by the 21st of August. Not a fantastic trade by any means, just a few points, but I just thought that, you know, worth having an entrance for. So that was that trade I took on the 20th of August. And this, it was using this principle. The sentiment was fresh, it was significant, it was new, okay? So, just get rid of that. Sorry about this. Been preparing some material for my next trip to Dubai, and I haven't got rid of all my notes. I've been combining two different things and two different keynotes. So my apologies for some of the typos, but I want to focus on getting the good information for you guys rather than spending all my time making the keynote look pretty. My key thing is getting the information and the content for you guys, because that's what matters, okay? Right, so here we go. This is the key bit to realize. Get into your heads. When I get a fresh, significant changing sentiment, I've got a phase one, I've got a phase two, okay? Phase one is out of the event. Ideally, on these big moves, you want to be in within 4, 5, 6 minutes, okay? You're getting in that initial move and taking that initial spike, okay? Then the second phase, you want to get in with 24, maybe 48 hours. As a general rule, there's obviously exceptions, because if there was another data point that was out, you know, if the RBNZ were meeting the next day, then you don't want to just be keeping a market, a limit order in the market. But I was happy with this situation. Phase two, within 24, 48 hours, 50% retrace, take profits at the previous high or low, okay? There we go. If you need to go through this again, get the recording, go through it again. It's well worth you going through a number of times. Get it down. It'll help you, okay? 50% retrace, very helpful. Make sure you don't have your stop too tight. If your stop's too tight, that's tricky. Having the stop wider is more helpful, but it's hard when you're practicing, because you'll lack the conviction, oh, is this a good trade, or is that not a good trade? That's a normal part of learning. So obviously just trade on demo, or with a very limited amount of money until you've got that confidence up, okay? And when you've got the confidence, then you can start, you know, risking what you normally risk. So, okay, examples of current sentiment shifts to watch out for. Fed, okay? The US dollar, watch out for September the 18th meeting. Powell speaking on Friday was quite upbeat. The chances of 50 basis points rate cut look unlikely, okay? So when the Fed gives their rate meeting on the 18th of September, we might see a sentiment shift. It's one to mark, okay? Better to take a handful of really clear sentiment shifts rather than just inventing reasons to trade in the market, okay? Another one, Canadian dollar. That's moving at the moment. Expectations of what the Bank of Canada will do next. The bank is standing out as a lone hawk among the world's major central banks. And their last rate meeting, they were kind of expected to turn dovish, but they didn't. Okay, so things are quite good for them. Inflation's target, GDP had a good surprise recently. So now the market's expecting only 15.9% of a rate cut. I looked at the world's probability index just this morning, and that's the probabilities. So things got better for the Canadian dollar. So what that means is that any information that kind of, if there's a sudden downtick in economic data, you're going to see the Canadian dollar sell off. But if, like, the Bank of Canada makes more hawkish comments, or there's some more positive data, think of retail sales out on Friday, you know, that could be potentially supportive of Canadian dollar. So that tells me retail sales data in Canada could be quite, could be interesting. Not a massive market mover. You might get 20, 30 points potentially, but, you know, I think that's one to have an eye on for Friday. Pound, okay? Driven by Brexit concerns at the moment. So watch for any breaking news that hands power back to PM Johnson. If PM Johnson is able to get back control of Parliament and force Britain to leave the EU without a deal on the 31st of October, you're going to expect sellers to enter in the market straight away for the pound. So watch out for breaking news that says that, and then watch out for breaking news that indicates a deal will be done with the EU. Okay, these two things, okay? So if a deal will be done, expect the pound to instantly rally. And if you miss the initial move, then there's potential looking at the 50% retrace. Here is the rough, you know, if a deal's coming, that's pound positive. If a deal's not coming, that's pound negative. That's the general rule of thumb that's the lens within which to view all the incoming data. Okay. Okay, euro, right. The market is expecting a dovish shift on Thursday. So the sentiment expectations are ECB to cut rates by 10 basis points or 20 basis points. They look likely to announce some sort of deposit tiering system. In other words, if they go into negative interest rates, that's not very attractive for retail customers. You know, if you go into your bank and the bank says, oh yes, you know, your savings account, you're going to owe us money for saving your money with us. A lot of, you know, everyday investors are just not going to accept that. So this deposit tiering system was used in Switzerland. So it means that, you know, retail customers and people just using the bank like everyday people, they're not going to be charged for their savings, which is essentially what a negative interest rate does. You know, it charges for your savings. But the ECB says, no, we'll have a tiering system. So some money will be exempt. And then they're also looking at restarting quantitative easing. So there is the expectations. The extent to which they deviate from those expectations is going to move the euro. So say, for example, the ECB meet, they don't cut rates, they don't introduce quantitative easing, then we'd expect immediate euro buyers. And that would be a phase one opportunity, okay? So if the ECB on Thursday said, oh, yeah, we haven't cut interest rates, we think things are better than we were expecting, and we're not going to introduce any quantitative easing, and, you know, we think that the German economy is going to turn around, so, you know, we're not too worried, then you'd expect immediate euro buyers. So just remember, the market's been expecting something dovish from the ECB. So that if they do kind of exactly what's expected, then you might get a sell the rumor buy the fact outcome. But you've got to watch the statement carefully, because if they do what's expected, but then say, and now we're on a series of, you know, rate cuts, or we're going to be massively increasing QE, you might still see the euro sell off. But just to be aware of that. Take a screenshot of that because we're running out of time. And the yen and the Swiss franc, we know they're safe haven plays. So if we get, you know, a big change in risk tone, this will impact the yen and the Swiss franc. You can see if a trade war is getting worse, we're going to see the yen and the Swiss franc bid. If the trade war is getting better, the yen and the Swiss franc will be sold. And we're seeing a little bit of yen strength coming into the market now. We're looking, I'll just take a quick screenshot of the US and UK stocks, and you can just see, look, a little bit of risk off tone coming in here. Okay, S&P 500 down 0.6%, futures S&P 500 0.5%, Nasdaq nearly a full percent, Dow 0.23%, UK FTSE 100. Yeah, we're starting to see some red, aren't we, in the equity? So with that risk-off tone is starting to come into the market a bit more. And then, okay, we looked at the Australian dollar, Japanese yen pair, didn't we? And we're seeing some yen strength coming into the market as well, which is reflecting that equity uptick. So that's one to watch, okay? Obviously, I'm away from my feeds and what's going on, but that's, you know, a key thing to be looking at as we're going in. Guys, I hope that is helpful, okay? I hope that is helpful for you. I hope that's been a really good lesson. I wanted to spend some time doing this. I want to look at this in more detail in these coming weeks. I want to try and focus in on these sentiment shifts. It'd be helpful for me to know if you're finding this helpful. That's the thing that I think is a key thing to look at. Free resources to work out sentiment by yourself, they're there. Also consider a paid news feed. Something like Rand Squawk is very helpful and worth looking at, so you can keep up on top of sentiment. Let's have a look. Yes, okay, that is pretty much all we have time for. Don't forget this offer by HYCM. If you deposit $1,500 with HYCM, you get a 1-hour coaching session with myself. If you deposit $3,000, you get a 1-hour session and a 1-hour trading follow-up review with myself. And if you deposit $10,000, you get a 2-hour coaching session with me, 1-hour follow-up, and 1 week's VI support from me, where I can just, you know, comment on any maybe trades you're looking at and add, you know, anything to help you with your education there. So it's a good little offer that HYCM do, and people find it helpful when they've taken up these plans and had a little bit of a time with me. And obviously the benefit of it is I can speak to people personally, and it can help people, you know, focus on the area of trading where they may be struggling with. Oh, good. I'm glad that's helped, Aaron. I think it's such an important area to look at, and it's a practice. It's a thing to practice, that kind of that trading, that shift of sentiment. Ask yourself the question: is it new? Is it significant? You know, like, let me show you something. Okay, this is kind of the question to ask. Okay, if you think it, so trading news. Okay, so if that's news. If you just remember news, it should help you. Is it like, ask yourself, so is it, you'll see what I do when I've got this done. Let me write it down. Right. Here we go, nearly there. It's not brilliant or anything, but it's just helpful, isn't it? Like, ask yourself this. Oh, nearly there. Is it new? Is it significant? Right? That news, N-E-W-S, see the news is highlighted just like news. Is it new? Is it significant? So if you can remember news, you can remember some of, you know, the key concept of trading fresh sentiment. Is it new? Is it significant? Often on the, you know, oh, good, Saeed. I'm glad that's helpful. Good, that's great. And thank you all for your questions and your input into the session. I'm really pleased with how quickly some of you guys are learning, and that's really good for me to see and really satisfying. So excellent, guys. Thank you very much. It's been a real pleasure. And don't forget, we'll be looking on Monday at 12:30 GMT. We'll be looking at the FX week ahead, as we do each week. So Monday, we look ahead, what key events are coming, and Tuesday, we look at things in a little bit more depth and more deep detail. Don't forget to contact me here at if you've got a topic you want covering or an area you're struggling with, you know, where are you struggling with your trading? Just let me know, okay? And you know, some of you guys have been attending this webinar for some time, so we might start having, in fact, I think what we should do, we should start having a section. I'm going to put it in now for next week so I don't forget, okay? I'm going to put in a section that says, what trades are you looking at? That's what we're going to do from next week, okay? So by having a what trades are you looking at session, we can start, you know, I can hopefully, you know, point out something, if something's like really standing out to me as, you know, how, hang on, that currency is really going to go the opposite to what you're saying. Or if you're thinking, okay, yeah, that would make sense to me, here's what to look for. I hope you guys might find that helpful. Again, it's not trading advice. That's the key thing to realize, because I have to mention that legally. So I can't give trading advice. That's very important. But from an educational perspective, like that is, you know, definitely I'm putting that in because I think that'd be really helpful. That's what I would have found really helpful when I was learning. And I hope you guys found that helpful too. Guys, thanks a lot for attending, and take care. Have a good week, and I'll see some of you on Monday. Bye for now.